Silver equilibrium trap. 30% up from the bottom, 30% down from the top. Perfectly balanced, or so it appears. But beneath this calm surface, something fractured. COMEX registered inventory just collapsed below a threshold not seen in modern history. 325 million ounces of paper claims chasing 98 million ounces of physical metal. February 27th, 14 days away, first notice day. The ratio hit 3.3 to 1, and most people won't connect what this means until it's already too late. The equilibrium isn't holding the market together, it's the trap. Before the break, no one sees approaching. Welcome to the boring currency. Now, if you've been around long enough to remember when a handshake meant something in business, when agreements were made on trust, not just contracts, then you understand the value of reliable information. We ask you with the same respect one would ask a seasoned professional to subscribe to this channel, not for entertainment, but because strategic warnings like this don't come with second chances. And before we proceed, we're curious, from which corner of the world are you watching this analysis? London, New York, Mumbai, Singapore? Let us know in the comments below. Now, let's examine what's really happening. The silver market sits at $82 per ounce in Western spot exchanges, a number that appears unremarkable at first glance. But when an analyst places this price point against recent market history, a peculiar pattern emerges. Silver rallied from approximately $63.90 to a peak near $93. That represents a gain of roughly 30%. Then it corrected downward to its current position around $82. That declined from the peak also roughly 30%. Mathematically perfect balance. Bulls who bought the bottom got their validation. Bears who shorted the top got theirs as well. Both sides now watch the same price level, seeing completely different futures. This is what market professionals call equilibrium. But there exists a critical distinction that most traders miss. There is equilibrium, and then there's an equilibrium trap. True equilibrium suggests balance, stability, a market that has found fair value where supply meets demand at a sustainable price point. Participants on both sides feel satisfied. The market breathes normally. An equilibrium trap looks identical on the surface. The price sits steady. Volatility compresses. Daily ranges narrow. To the casual observer, the market appears calm, balanced, safe even. But underneath, something is broken. The trap forms when surface price stability masks structural instability beneath. When the visible metrics suggest balance, while invisible fractures spread through the foundation, when participants mistake the absence of movement for the absence of risk. History provides clear examples of this phenomenon. In early 2000, palladium traded in a range that appeared stable. Price oscillated within predictable boundaries. Technical analysts drew support and resistance lines. Traders positioned for continued range-bound behavior. Then the Russian supply situation deteriorated. The equilibrium shattered. Palladium went from $400 to over $1,000 in months. The market wasn't balanced. It was coiled. Silver now exhibits similar characteristics. Western paper markets show the $82 price. Futures contracts trade at the same level. Order books appear normal. Open interest sits at manageable levels by historical standards. Technical indicators suggest neither extreme fear nor extreme greed, but Eastern physical markets tell a different story. Shanghai spot silver trades at $88. Shanghai futures at $90. That represents a $6 to 8-out premium over Western prices. This premium has held steady for weeks now, not widening dramatically, not closing either, just persisting. When physical metal in one geography consistently trades at a premium to paper contracts in another geography, the market is sending a signal. Eastern buyers are paying more for physical delivery than Western traders are paying for paper exposure. This spread reveals something fundamental. It reveals that different participants see different realities. Paper traders in New York and London see resistance levels, moving averages and technical patterns suggesting silver could move lower. Physical buyers, in Shanghai and Mumbai see value. They see industrial necessity. They see monetary insurance. They see different risk. The equilibrium price of $82 satisfies neither group completely. Paper traders want lower prices to justify short positions or validate bearish calls. Physical buyers want lower prices to accumulate more metal. yet both keep the price anchored for now. This is the illusion. The illusion is that balance means safety, that when a market sits between competing forces of equal strength, it will remain there. That equilibrium is a destination rather than a temporary state. Markets do not remain in equilibrium when structural forces build pressure beneath the surface. They remain in equilibrium until they don't. And when equilibrium breaks in commodity markets, it rarely breaks gently. It doesn't drift slowly from one price level to another over months of gradual adjustment. It gaps, it surges, it collapses. The break is violent precisely because the equilibrium compressed so much potential energy. Silver sits at this inflection point. Now 30% up from the low, 30% down from the high, perfectly positioned between two narratives, two possible futures. Two groups of participants watching the same chart, seeing opposite outcomes. But something changed recently that most market observers have not yet processed. Something broke beneath the surface while everyone watched the price bounce between support and resistance. And that break will determine which side of the equilibrium trap gets validated. The question is not whether silver moves 30%. The question is which direction and what triggers the break. On a single trading day in February, 5 million ounces of registered silver vanished from COMEX vaults. Not sold, not transferred to eligible status, not reclassified, gone, withdrawn for delivery. And with that withdrawal, a threshold was crossed that has never been breached in the modern era of commodity tracking. COMEX registered silver inventory now sits at 98 million ounces below 100 million for the first time. To understand why this matters, one must understand what registered inventory actually represents in the architecture of futures markets. The COMEX warehouse system divides silver into two categories, eligible and registered. Eligible silver sits in approved vaults but carries no obligation. It belongs to private parties who simply store metal in COMEX. Approved facilities. That silver might never enter the market. It might sit for years, decades even. Registered silver is different. Registered silver stands ready for delivery against futures contracts. It represents the physical metal, backing the paper promises traded on the exchange. When a contract holder demands delivery instead of cash settlement, registered inventory is what must be delivered. This is the metal that makes the system work. For years, decades actually, COMEX registered silver inventory fluctuated but remained above comfortable thresholds. 150 million ounces, 200 million ounces, sometimes higher. The system had cushion, buffer, room for delivery demands without stress. That cushion no longer exists. 98 million ounces of registered silver now backs the entire COMEX futures complex. And against this physical inventory stands a tower of paper claims that defies rational analysis. March contract open interest currently sits at approximately 65,000 contracts. Each contract represents 5,000 ounces. 65,000 contracts equals 325 million ounces of silver. 325 million ounces of paper claims, 98 million ounces of registered physical metal. The ratio just hit 3.3 to 1. For every ounce of actual silver available for delivery, there are more than 3 ounces of contractual claims demanding that same metal. Now, defenders of the system will immediately point out that most futures contracts never go to delivery. They settle in cash. Traders close positions before expiration. Speculators roll contracts forward. The system depends on this behavior. It was designed for it. But the design assumes that physical metal availability never becomes questioned. The design assumes registered inventory remains adequate to meet whatever small percentage of contracts actually demands delivery. The design assumes confidence, and confidence is starting to crack. February 27th marks first notice day for March contracts. That date sits 14 days away as this analysis is recorded. On that day, contract holders must declare their intentions, cash settlement or physical delivery. Historically, between 2 and 5% of open interest typically goes to delivery in silver futures, sometimes less. Rarely more than 10% even in tight markets. But what happens if March sees unusual delivery demand? What happens if even 15% of open interest demands metal? 15% of 65,000 contracts equals 9,750 contracts. That represents 48.75 million ounces. nearly half of total registered inventory claimed by a single month's deliveries, and April contracts are already building open interest behind March, then May, then July. The mathematics become uncomfortable quickly. This is not speculation about some distant crisis. This is not a theoretical model of what could happen under extreme circumstances. This is simple arithmetic applied to publicly available data. 325 million ounces. Claimed 98 million ounces available, 14 days until first notice. And here is what makes this situation different from previous episodes of inventory tightness. The 5 million ounce withdrawal that broke the 100 million threshold. It did not occur during a price spike. It did not happen amid panic or shortage fears. It occurred while silver traded in its equilibrium range, calm, stable, unremarkable. Someone or multiple someones looked at $82 silver and decided that physical possession mattered more than paper exposure. They withdrew metal while the market slept, and they left behind a ratio that has never existed in modern COMEX history. 3.3 paper claims for every physical ounce. Most analysts watch price charts. They study moving averages and momentum indicators. They debate whether $82 represents support or resistance. But the real break already happened. It happened in the vault. It happened when registered inventory crossed below 100 million ounces. It happened when the ratio exceeded 3.1. The market has not priced this in yet, because most participants have not connected what it means. But February 27th approaches, and with it the first test of whether confidence holds or breaks. The Silver Institute released its annual outlook 3 weeks ago. Most market participants scrolled past the headline. Another deficit forecast. Another year of supply falling short of demand. The report appeared routine, expected even, but buried in the data. A pattern emerges that changes everything. Year 1 of deficit. Markets can absorb. Year 2, inventory buffers compensate. Year 3, above-ground stocks begin thinning. But year 6 of consecutive structural deficit is not a cyclical imbalance. It is depletion. The Silver Institute projects a 67 million ounce deficit for the current year. That number alone seems manageable. The world produces roughly 800 million ounces annually for mining. 67 million represents less than 10% of total production, except deficits compound. If demand exceeds supply by 67 million ounces this year and similar amounts in the 5 years prior, the cumulative shortfall approaches 400 million ounces over 6 years. 400 million ounces that came from somewhere. They came from above-ground inventories, from stockpiles, from vaults and warehouses and storage facilities that accumulated metal during previous surplus years. Those reserves are not infinite, and here is where the mathematics becomes stark. COMEX registered inventory sits at 98 million ounces. Total COMEX inventory, including eligible roughly 300 million ounces. London Bullion Market Association vaults hold additional reserves. ETF holdings represent another pool. Private storage adds more, but total visible above-ground silver inventories, the metal that can be accounted for and accessed, amounts to approximately 2 billion ounces globally. 2 billion sounds. Substantial until one realizes that annual demand now exceeds 1.2 billion ounces. At current consumption rates, even with zero growth, visible inventories represent less than 2 years of global demand, and those inventories have been declining steadily as 6 consecutive years of deficits drew them down. The convergence point approaches faster than most analysts model. What drives this relentless demand? Investment represents one component. The Silver Institute reports investment demand surged 20% to 227 million ounces, a 3-year high. But investment demand fluctuates with sentiment. It can reverse. Industrial demand cannot. Solar panel production consumes over 130 million ounces annually. That number grows as renewable energy deployment accelerates globally. Every solar panel requires silver paste for photovoltaic cells. No substitute matches silver's conductivity at the required efficiency levels. Electronics manufacturing demands another 200 million ounces. Smartphones, computers, servers, data centers. The digital economy runs on silver connections and silver circuits. Electric vehicles use substantially more silver than internal combustion vehicles. Charging infrastructure requires silver contacts rated for high current applications. As transportation electrifies, silver demand from this sector multiplies. Medical applications, water purification, antimicrobial coatings, industrial catalysts. These are not luxury uses that disappear during economic slowdowns. These are baseline requirements of modern industrial civilization, and they total over 600 million ounces annually, before counting investment demand or monetary uses. Mining production increases marginally year over year. New discoveries are rare. Most silver comes as a byproduct of copper, lead, and zinc mining. Primary silver mines represent a small fraction of supply. This means silver production cannot simply ramp up in response to price signals the way oil production might. The supply curve is relatively inelastic, constrained by geology and mining economics that move slowly. So demand grows, supply grows modestly, the gap persists year after year, deficit after deficit, drawing down the reserves that took decades to accumulate. And now something new enters the equation. India. Indian import data for the past 6 months shows acceleration, not speculation, not trading. Physical accumulation by a population that has trusted precious metals for generations. When Western paper markets sell based on technical resistance, Eastern physical buyers accumulate based on value perception. When COMEX shows 325 million ounces of paper claims against 98 million ounces of registered metal, Indian buyers see opportunity at $82. They remember when silver traded below $20. They remember $30, $50, $82 with a structural deficit. That calculation makes sense to long-term physical holders. This creates the convergence. On one side, 6 years of deficit depleting above-ground inventories. On the other side, COMEX registered inventory collapsing below 100 million ounces. In the middle, March delivery pressure building toward February 27th first notice day. And underneath all of it, relentless industrial consumption that cannot stop without stopping the technologies that define modern life. The deficit is not a forecast anymore. It is a reality that has already consumed 400 million ounces of inventory over 6 years. And the inventory that remains is increasingly spoken for. The convergence point is not theoretical. It is mathematical, and it approaches whether markets price it in or not. Two realities exist simultaneously in the silver market right now. Paper traders see resistance at $85. They watch the 150 exponential moving average on hourly charts. They note that silver recently tested this level and failed. Price fell back below it. In technical analysis terms, that level now acts as resistance instead of support. This matters to short-term positioning and matters to traders. Is managing paper contracts with tight stop losses. It matters to those reading price action for directional clues. The technical structure suggests silver could move lower from current levels, perhaps back towards $75 or maybe $70. Bears point to failed breakout attempts, weakening momentum indicators, volume patterns that suggest exhaustion rather than accumulation. They are not wrong about what the charts show, but physical buyers see something entirely different. They see $82 silver with a 6-year structural deficit. They see COMEX registered inventory at 98 million ounces. They see 3.3 paper claims per physical ounce. They see March delivery pressure 14 days away. They see value, not value in the sense of a good trade. Value in the sense of asymmetric risk. Value in the sense that downside appears limited by industrial floor demand, while upside remains uncapped by structural shortage reality. These two groups, paper traders and physical buyers, operate in the same market, but see completely different risk-reward profiles. In this divergence, this is where the break forms. Consider the mathematics of the current setup. If silver drops 30% from $82, it reaches approximately $57. At that price, industrial users would accelerate purchasing. Solar manufacturers would lock in supply contracts. Electronics producers would build inventory. Investment demand would surge as precious metals. Investors recognized historical value. $57 silver with a structural deficit would not last. But if silver rises 30% from $82, it reaches $16. At that price, COMEX delivery pressure intensifies. The 3.3 ratio of paper to physical becomes untenable. Short covering accelerates. Eastern. Premium widens further. $16 silver with collapsing registered inventory, and March deliveries pending would not stabilize. This is the equilibrium trap. Downside risk appears contained by fundamental demand floors. Upside risk appears explosive due to structural supply constraints. The 30% move in either direction leads to vastly different outcomes. A 30% decline likely reverses quickly as value buyers emerge. A 30% rally likely accelerates as structural realities force recognition. The break approaching is not about which direction price moves first. The break is about what happens after the initial move. And timing factors now converge in ways that compress the decision window. February 27th, first notice day for March contracts. Contract holders must declare intentions. Physical delivery or cash settlement. If delivery demands exceed historical norms, the squeeze begins immediately. Spring approaches, industrial restocking cycles activate. Solar panel manufacturers prepare for installation season. Electronics production ramps for summer consumer demand. Geopolitical variables add uncertainty. Trade relationships shift. Supply chains face disruption risks. Currency volatility affects metal pricing dynamics. Central banks navigate inflation data while managing economic growth concerns. Policy decisions in the coming months will influence currency values which directly impact commodity prices denominated in those currencies. All of these factors, independent variables on their own, now converge within a 6-week window. Business leaders must understand what this means for strategic planning. For companies that use silver as an industrial input, supply chain risk just escalated. The equilibrium price of $82 may not reflect actual procurement costs if physical premiums widen. Delivery delays become possible if COMEX stress translates to broader market tightness. Procurement. Departments should model scenarios where silver costs rise 20 to 40% within a quarter, not as a base case, but as a realistic risk case that deserves hedging consideration. For portfolio managers and institutional investors, silver presents asymmetric positioning opportunity. The downside appears bounded by industrial demand and deficit fundamentals. The upside remains open-ended. If structural shortage forces price discovery beyond paper market resistance levels, risk management frameworks should account for non-linear outcomes. The equilibrium will not likely drift slowly in one direction. It will break sharply, and the initial move may accelerate rather than revert. For entrepreneurs and business owners watching commodity markets for economic signals, silver tells a specific story right now. It tells the story of paper systems meeting physical constraints. It tells the story of confidence eroding in derivative markets when underlying assets become scarce. It tells the story of what happens when decades of deficit spending, whether in fiscal policy or commodity inventory, finally reach mathematical limits. The silver market is a microcosm, a small enough market to break visibly when stress exceeds system capacity, but large enough to matter. Large enough that the break will be noticed. Large enough that the consequences will ripple through industrial supply chains and financial markets. And the break approaches now, not in some distant future, not as a theoretical possibility. The COMEX inventory already broke below 100 million ounces. The ratio already hit 3.3 to 1. The deficit already reached year 6. First notice day already sits 14 days away. These are not predictions. These are present realities that most market participants have not yet connected into a coherent narrative. The equilibrium looks calm on the surface. $82 stable balance between 30% up and 30% down. But beneath that surface, the structure fractured, and fractures in commodity markets do not heal. They propagate. The question facing anyone with exposure to silver markets, whether as industrial user, investor, or economic observer, is not whether the equilibrium holds. Equilibrium traps never hold indefinitely. The question is whether you position before the break becomes obvious to everyone or after. After means paying the break price. After means accepting whatever terms the market demands when structural shortage becomes undeniable. Before means recognizing what the data already shows. 98 million ounces registered, 325 million ounces claimed. 67 million ounce deficit, 14 days to first notice. The break no one sees approaching is already in motion. The only question remaining is who recognizes it first?